Welcome to Crescat Gets Activist on Gold and Silver, episode number 159. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please refer to our important disclosures pages on the screen now. These disclosures can also be found in the description on Crescat's YouTube channel and on our website. So the purpose of our videos is to share timely macro news as well as newsworthy geologic updates, both positive and negative, across our holdings as they arise. These videos represent the opinions of Crescat as a mining and exploration industry advocate. Our objective is to share the overall geologic progress of our activist strategy in creating new economic metal deposits in viable mining jurisdictions around the world. So if you enjoy our videos, please click on the like button and make sure you're subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on Twitter for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about our investment strategies, we encourage you to reach out to Merrick. His contact information is on the screen now and can also be found on our website at crescat.net. So let's get started. Just so everyone knows, this video has been pre-recorded on Thursday because both Tavi and Quinton will be traveling tomorrow, or at least Tavi's traveling, and so and Quinton's not available at the normal time, and so we're just doing a pre-recording. That said, tomorrow, Friday, when people should be watching this, is option expiration Friday for March. And one thing that I would like to point out is that option writing strategies have been extremely popular. And one thing to there's what Bloomberg has called the cousin of Volmageddon. The cousin of Volmageddon trade is gathering billions, they claim, and we've noticed this, that there's a lot of option writing strategies out there today, and there's some ETFs that allow investors to participate in option writing strategies. Well, what was going on before Volmageddon in 2018, when the VIX, one of the VIX ETFs, blew up, and we had what has since been dubbed Volmageddon, and a lot of short writing strategies really suffered, and there was a brief market meltdown, at least at that time. Crescat did profit during that time, but at least in our global macro and long short strategies. But look, we have another setup, we think, for another Volmageddon type type event. Will it happen on option expiration Friday? A triple witching? I don't, who knows? But there are close to $60 billion that are in these option writing ETFs. They're not exactly the same as a short VIX. They also have long positions outright in the stock, and along with option writing strategies. But there is a lot of these, with the 0 days to expiration options that are out there now. There's been an explosion of volatility products and new short duration options, and you can see with the ramp up in these ETFs that are doing option writing strategies, 60 billion compared to about 3.5 billion of assets prior to Volmageddon. So the assets in these strategies is enormously higher today. Let's go on to the next. Another analog that we want to point out. We've pointed out so many of these that point out the risk that we are at another market top type of a situation, like 1929, like the Nifty 50 in 1972, like the tech bubble in 2000, like before the COVID recession and meltdown. The weight of high momentum stocks in the S&P 500 today is at all-time highs, and it's higher than all these comparable periods. This is data from Piper Sandler, from their strategists there, and it's just, we've looked at so many of these different ways that we are at a comparable level of frothiness relative to these other times. We just want to continue to point out that the risk in the markets today is really high. Let's go on to the next. Now this is a chart that we have updated. Many of you will know that I put this chart out, towards the end of 2021, right before that top that we had in the market in 2021. And while we did very well with our short positions in mega cap tech stocks in 2022, continuing with that trade hurt us throughout 2023. It's actually not doing so bad for us year to date in our long, short, and global macro strategies, but here we are again at what we believe is could be a double top in this measure of enterprise value relative to GDP. Why is this so important? Well, it shows that the money is concentrated in these companies that make up such a big portion of the economy today, in terms of their share of earnings and revenues and free cash flow, profit margins. But even when you stack on top of that, the valuation multiples, which people say, oh, they're not that high, they were higher in 2000. Well, this is another way of looking at valuation multiples, enterprise value relative to GDP, that show that the valuations are even higher than we were at the peak of the tech bubble in 2000. And so when companies become so big that they can no longer potentially grow at a super high rate relative to the economy, these are setups for potential market top situations and significant downturns and recessions. We at Crescat, we believe we have a number of signals that we are near one of these tops, that we're heading into a recession. We think it's going to be a stagflationary variety, like in other times, which you've heard me say this a million times, but bears repeating. Here we are at a double top looking pattern on this enterprise value to GDP for the top 10 tech stocks in the S&P 500. And it's like twice the valuation that they were at the peak of the tech bubble. Let's go on to the next. I've shown this one before. I just want to reiterate that the fundamentals at both Microsoft and Apple, the two largest market cap companies in the S&P 500 and in the world, the fundamentals in terms of free cash flow, according to the mean analyst estimate on Wall Street as collected by Bloomberg, this quarter will be down year over year, 16% for Microsoft based on the current estimate year over year, and something in like the high 20% for Apple, close to 30% for Apple year over year decline. And you can see that these estimates have been coming down consistently for 2 years straight now, at the same time as the stock price has been diverging the other way. We think this is a divergence that is just signaling that we are, that we're in a market that doesn't make a lot of sense. It's been a momentum market, as one of those earlier charts just showed, and valuations are extremely high, and the fundamentals are starting to turn down, we think, ahead of a coming recession. Let's go on to the next. NVIDIA has been the Magnificent Seven stock that has really led the charge this year among these top 10 mega cap tech stocks, and what more recently became dubbed the Magnificent Seven. Well, on a record volume day for the year, last Friday, you can see that NVIDIA did this bearish engulfing candle, and this is just a technical indicator. On a number of valuation metrics, NVIDIA is the highest it's ever been in our model as well. So there are value, the growth is currently still very high, no question about that. But according to a number of valuation metrics in our model, just like at Apple and Microsoft, historically high multiples, with NVIDIA, unlike Apple and Microsoft, where the growth is turning down, at NVIDIA there's still strong growth, but the growth is decelerating. We believe the growth will be decelerating, and now the market is doing this bearish engulfing, and going into options expiration on Friday. Who knows? I'm not saying it could just keep screaming higher for all we know, but we think things are frothy, and this is a technical signal that maybe NVIDIA is topping out, just maybe. Let's go on to the next. So there's been a lot of inflation data that's come out recently, CPI, PPI. On Tuesday, CPI came out. Liz Ann Saunders at Schwab pointed out that the CPI core services ex housing, which the Fed calls the super core, and it's something that they pay attention to, increased by 6.9%. So this is annualized rate of super core inflation of 6.9%. We've talked about another wave of inflation, a second wave of inflation coming, as the Fed is waiting and everyone's hoping that inflation is going to decelerate down to 2%. We're still seeing some signals that inflation is reaccelerating, and in this measure, it's showing that we're at 6.9%. Let's go on to the next. Similarly, Lisa Abramowitz at Bloomberg pointed out yesterday that the Atlanta Fed's gauge of sticky inflation has been on the rise again, and it's risen to about 5% on a 3-month annualized basis. So inflation is moving in the wrong direction for the Fed, and this is the big problem. This is why we have these combination of macro themes that suggest that we are going to be going into a stagflationary recession environment. This is the type of market that that in the 1973, 1974 bear market really led to the collapse of these high multiple mega cap growth stocks and mega cap tech stocks, at the same time as commodities, gold and silver and mining stocks and oil and gas stocks all had substantial increases. We think this is the type of market that we're about to be going into. Is there a guarantee that we're going to be going into this type of market? No, nothing is for certain, but we have a strong belief in many factors that we think we are heading into this type of market. I know we've been calling for it for a long time. We've seen fits and starts of it, but again, we think we are right on the precipice of both the long commodity side and the short, hyper overvalued mega cap growth, shorts that we have in our global macro and long short strategy. We think the combination of both of those things to play out at the same time is ripe to unfold. Let's go on to the next. This shows, this is looking at the XOP ETF. What's that? It's an equal weighted oil and gas industry ETF. And what it shows, these are oil and gas stocks, E&P exploration and production stocks. And what it shows is that April is the best performing month on a seasonal basis in the 16 years that this ETF has been around. On average, April is the best performing month for this index. So as many of you know, in our global macro and long short strategies, as well as our large cap strategy, we have an oil and gas, long oil and gas theme. We've just been beefing it up recently ahead of this April month. And we think it's part of the picture that's likely to be unfolding as we see commodity price rises, and we think we're going to start to see that within oil and gas and within our oil and gas stocks. Is there a guarantee that this is going to happen? Absolutely not. But on average, you can see we have some pretty strong evidence, and the valuations are cheap according to our model. in the oil and gas stocks that we own. Let's go on to the next. As people know, gold has recently broken out to new all-time highs. The yellow line here shows gold breaking out about, I think convincingly this time above $2,000 an ounce. But it's also looking at the Philadelphia Gold and Silver Index, which is the benchmark for our precious metals fund and our precious metals SMA, and it's more of a larger cap benchmark and index, and today we're a little bit more focused on the exploration and smaller cap side of things in our portfolios, but it's just showing how depressed that gold and silver mining stocks are relative to gold itself, as gold is breaking out. There's a lot of catch up to do, and when you look at the smaller cap gold stocks, it shows that even more depressed levels relative to gold. So a lot of catch up to do. We think there's incredible valuation based upon our model today, deeply undervalued portfolio with a lot of appreciation potential ahead. There's always risks, and mining is inherently risky. We think we've been through one of those risky periods here recently where we've seen that downside, and we believe there's a lot of catch up and upside still to come from here. Do I have any more? Slide it over to Tavi now and to continue the macro discussion.
All right, everyone. I recorded my presentation here for this Friday afternoon, and so would like to just talk about some of the most important charts that I've seen in the last 2 weeks. I don't think we didn't do a presentation in the prior week after PDAC. We took a little break, but we're back now. And today, there are some important things happening in the inflation story, and particularly with what's happening with agricultural commodities. As you can see in this chart, we're making new highs in those prices of soft and commodities overall, and it's actually higher than it was at the Russian invasion levels that we saw back in 2022. This is going to have, in my opinion, very important inflationary implications in the global economy. In particular, I believe this is going to probably drive food prices much higher worldwide. And so, there are a lot of issues regarding food prices that has been also a big driver of inflation. And I think this chart, it's absolutely critical to be paying attention to. Let's go to the next chart. And by the way, if you looked at equal weighted index for commodities, what you're going to find is that a lot of those charts also had a strong performance all the way back to 2022, and they have leveled off since then. Some of them have been, in fact, consolidating since those periods. And now you're starting to see some of those commodities make new highs. Now, outside of some specific ones, speaking more macro, you're seeing agricultural commodities being one of them. But you also have other things like gold already making new highs. And there's other things that are lagging that I think will make new highs soon. And it's just my opinion, as we see this inflation thesis continuing to unfold. And that's probably oil, that's probably silver, it's probably copper, and some other things. In this chart right now, we're looking at the financial conditions, and this has collapsed most accommodative levels in the last 2 years. How is this measured? I mean, there's a lot of things that measure this, but basically it's been a suppression of volatility overall, caused by VIX being so low and credit spreads being very tight, and other things, including interest rates as well. Is starting to show that this accommodative levels in the last 2 years, in my opinion, is not being linked to the potential of the reacceleration of inflation. So when we go to the next chart, you can kind of see here an inflation expectation starting to rise. So we're looking at break-evens. Break-evens is the way that the market uses to look at the expectation for inflation, or the CPI to be very specific, in the following in different durations. In this case, I believe I'm looking at the 2-year duration, and you can see the divergence between the two, which makes sense. I mean, if if monetary policy or financial conditions are easing, in other words, becoming more loose, you would expect that inflation would also increase, or expectation of inflation would increase on the back of a looser monetary conditions or financial conditions. And so this is precisely what we're seeing here. In fact, if you go to the next chart, I think I have that. There we go. And I ask a question. And if the monetary base is rising, right now we're looking at monetary base in the US, which is measured by two things, essentially. There's money in circulation and reserves on the banks. We're seeing an increase of about $400 billion recently in the US monetary base, despite the fact that we are also, or the Fed is engaging one of the most restrictive, I should say, QT policies we've seen in history. And so the question really is, what we would one expect to see? How would the U.S. monetary base behave if we do have a recessionary environment playing out, which is, in our view, highly likely. And so, it's crazy to see that U.S. monetary base is increasing in the midst of one of the most restrictive monetary policies supposedly in history. And so, the main reason for this is the reverse repos and other banking facilities and other things. In fact, the day that I'm recording this, which is Thursday, we're seeing also the banks decline in prices, the regional banks. And this is happening in the last few days, actually, with the markets getting a little more challenging and volatility increasing. You're seeing the banks and regional banks actually leading to the downside, which is very important because, we're going to see here, we just had the end of those supplementary policies of the BTFP that they had, those, creative to help the credit crunch that we had in March of 2023. And that has actually expired about 3 or 4 days ago. And so as we see that now translating into some issues in the regional banks, and probably one of the main reasons why as well we're seeing the monetary base is starting to increase. And in my view, that also has to do with this situation where gold looks to be sniffing that maybe something is brewing in the credit crunch environment and causing, therefore, gold to rise because of the expectation that the Fed is going to have to do more, not less, and potentially cause the monetary base to exponentially grow like we saw back in the COVID stimulus period and other times as well. Let's go to the next chart. And so here you're seeing now the CPI number in white, which has been actually, I would say, very, it has surprised a lot of people how stubbornly high has continued to be. In fact, the core CPI remains near 4%. And you can see here that gasoline prices, forget about oil, forget about nat gas, gasoline prices, which is a substantial amount of what consumers, especially lower classes financially spend of their capital, is starting to rise again. It's starting to show that maybe there is a second wave of inflation. We've been talking about the potential for inflation developing through waves because of the historical analogs that we've seen in the 1970s and 1940s and even the 1910s, which were the last 3 decades that we had inflation in the US. And so that is highly likely, and therefore one of the reasons why I've been paying close attention to some of those metrics. I think 3 months ago or so, it was much harder to make the call that inflation could reaccelerate. But now we're seeing signs, not only agricultural commodities, but maybe now with the gasoline prices, potentially now oil, you have gold making new highs. And it's funny that people don't link gold prices with inflation. The gold bugs do. The gold bugs community definitely link that gold prices increase because inflation expectation is increasing. But the macro community often talks about that gold is rising because of the risk of deflation, the risk of the Fed doing more and all less. And those things are all linked. But I think that back in the 70s, there was a general sense that would be priced in markets where when inflation expectation rises, gold prices would rise as well. And I think we're starting to see that shift here in this market as well. And if you ask me, this gold market has certainly entered, in my opinion, a potential of a bull market here. And as we see that, it should unleash other opportunities in other things that are linked to gold prices, which are one of them being the miners and obviously other things that I will mention here in a minute. Let's go to the next chart. And so you're seeing the food spending share of disposable income. A chart from Wall Street Journal had this, it's making a 3-decade high. So how much people are spending on food is certainly increasing relative to how much money they make. That's the simple way to understand the chart. And so, the consumer is getting squeezed, but the consumer itself certainly is in a much better position than it was back in 2008. So if you look at the overall leverage that households have in the US relative to the disposable income or even relative to GDP itself, you can see that we've been in a process of deleveraging of most of the consumers because most of that is happening through a transfer of leverage from households to the government. And so you have, I'll give you one example, what's happening not only with the stimulus checks that happened a few years ago, but also the situation with forgiving student loans. And that's another example of a transfer of the debt problem from one side of the balance sheet to another. And so that's certainly what we're seeing in the consumer side, which makes me believe that the big short opportunity is monetary dilution, is the fact that the debasement of fiat currencies versus particularly hard assets that are incredibly cheap today relative to their history and relative to other financial assets, and are likely offering a much better risk reward opportunity. Let's go to the next chart. And so oil is an interesting one because oil reminds me of the gold market a few months ago. Oil was a very prominent narrative in most media outlets, and a lot of people were talking about energy prices increasing and so forth, and that has gone completely away. And in markets, when something gets neglected, usually it's a time where you want to be looking for those things to start becoming part of the news. There's an old saying that you want to, using the Wall Street Journal here as an example, you want to invest in the back pages of the Wall Street Journal and sell the front pages of it. So, I'm not seeing much of a lot of news regarding oil and energy in the last months and or so, even in the last year, especially regarding the bullish narrative that we had in the past. And now what we're seeing instead is, I think 2023, the big story in oil that really caused oil to be so challenging was really the domestic production. We've had domestically in the U.S. production, believe it or not, was higher than was expected by the market. So most of the producers in the U.S. actually increased their oil output, and therefore that added to the downward pressure in prices. Now we're seeing OPEC, some of the members of OPEC actually cheating, Iraq being one of them, doing 200,000 barrels a day more than they were supposed to do. And that's certainly adding to the picture of oil weakness. I would say that the market is also pricing in the risk of Trump coming back, and not the risk necessarily, but the fact that if Trump comes back, we would probably see a market that would be more favorable for oil producers to produce. And therefore supply should be higher, and therefore that should impact oil markets. And so markets are way ahead of a lot of people. And that's probably one of the reasons what we're seeing this weakness in oil prices. But if I could mention, the one thing that worries me about the overall economy is uncontrollable inflationary issues. And I think this is highly likely to develop as we especially with oil becoming a bigger part of this narrative. So an important level to watch for in oil prices is the $85 a barrel in a WTI contract. And look, I'm not trying to get technical here necessarily. There's plenty fundamental reasons to own oil from a perspective of, contraction of the rigs that we're seeing, oil and gas rigs, particularly gas, but also in the oil space that is starting to contract for the first time in a few years. And those things usually lead to also constraints when it comes to production that also leads to higher oil prices. Not to mention that the whole war premium and deglobalization premium and all the escalation that we're seeing of geopolitics happening is certainly doesn't seem to be priced into the oil prices today. And the other thing to mention is, if we do break out from this 85 level, which would be technically a breakout from all the way back to 2021, as you can see in this chart, which gold kind of looked like that not too long ago. And I think we're going to actually be chasing the prior highs. The prior highs were $130 a barrel. And what's is really interesting is that if you go to the next chart, what you find is the implied volatility for call options in anything related to energy pretty much is actually really low, meaning people are not expecting that we're going to see oil prices at much higher levels. And so as an investor, that is a contrarian opinion that I would certainly engage, because I think that that's worth of, I can come up with many potential reasons for why oil could be at $100 a barrel in 1 year or 2 years from now. And seeing how cheap it is to add that insurance to your portfolio if that happens, I think that that's a plausible way of expressing a very bullish energy view in the markets overall. In this case, we're looking at the 12-month at the money call option implied volatility for XOP ETF. It's an ETF that looks at energy companies. Majority of them are exploration and production. So XLE, which is the most liquid ETF in the energy space, would also show something very similar. I just picked this one because it was a little more pronounced for chart reasons, but all of them look really historically low when it comes to implied volatility. And I think it suggests that, it is time, at least for us, money managers, to be looking to scale up our positions in the energy space. Let's go to the next chart. By the way, I just find it hard to believe that we're going to see the reemergence of inflation with oil not being part of the picture. And I think that's a big portion of that. We've seen some of the things that are starting to price in the reemergence of inflation, and oil is definitely one that is lagging that potential narrative reemergence. And so I think that's an important one to be thinking about. Now this chart, now let's flip a little bit to gold, and then we're going to talk about the markets in a minute. But I think the only explanation for why we're seeing gold prices surge, and you look at the ETF assets under management declining, that's the red line. So you're looking at GLD, the most liquid ETF in the world, and you have the white line is the price of GLD, which is designed to follow gold prices. Therefore, if gold prices are surging, you would see oil, the white line surging, and that's what we're seeing. Now, the issue here is that there is usually a very strong connection with the general investor that is the largest buyer of GLD, usually drives gold prices higher. Now we're seeing a divergence. So the general investor is not participating in the purchases of gold, which leads to my conclusion or suggestion that potentially who is actually driving gold prices higher is not the general investor, it's actually central banks, which we know that central banks have been purchasing record amounts of gold in the last few years. And that's probably a trend. And I often think about this chart because, what would it do to the gold and precious metal space if we do have the red line starting to increase, which I think it's highly likely. And I'll explain why. Because if we go to the next chart, this is giving a perspective of, how much we could see of a percentage change of the ownership of gold as part of their foreign reserves or international reserves, whatever you want to call it. And as you can see here today, we're in a very low level, historically speaking. We're still below the 20% level. And, historically, as you can see here, all the way back to the 1970s, global central banks tend to hold about 40% of gold relative to their reserves. And this is mostly carried by what happened in the 70s, because in the 70s, gold was close to, I think it peaked at about 72 percent or close to 75% of their international reserves back in the late 70s and early 80s. And then we've had this big downtrend where central banks are starting to buy treasuries, U.S. treasuries, and other sovereign institutions, in which in my view, that actually had a very significant impact in creating what it was one of the longest secular is already long, but very long secular movement of declining interest rates globally, especially in developed economies. And so this was the case with global central banks. We also saw a lot of debasement of currencies happening during that period. And the debasement of currencies on the back of highly levered global economy, unlikely, we'll actually see most likely more monetary dilution given that situation. And that leads to instability of currencies, FX instability, volatility, and so forth. As we see that, in order for central banks to stop that volatility and reduce that instability of their own monetary systems, we believe they're going to be forced to buy gold. And so gold is what creates or reestablish that or has reestablished in the past that credibility of monetary systems. And we think this is going to be something similar. Let's go to the next chart. And so one interesting chart from that I found on Twitter, and by the way, the dates go back to 1975. It's missing number 1 there, so it's 975. So my apologies there. But you can see here that if you look at gold relative to, or gold miners relative to gold itself, which is the yellow line, boy, things look cheap, right? All the way back to 1975, we haven't seen such an undervalued market for the miners relative to gold since the 70s. And, I think this is quite normal. I think we all trying to find reasons for why the miners have been underperforming for so long. And I can't recall a time, at least in my career, that we've seen such a distressed market environment for the miners relative to gold itself. It's creating great opportunities in the private markets and even in the public markets, because companies are trading at such a low multiples relative to their fundamentals. But a lot of people, are not seeing that. And it's funny that the whole idea of investing usually is to buy low and sell high. I know some people like to buy high and sell higher, but the whole idea of investing is you're really looking for something, in my opinion, is to look for something really cheap and then sell it at very overvalued levels when you reach those absurd valuations that you disagree with. And the whole point of investing is really finding an idea that people will agree with you in the future and not today. And that certainly, I think, applies to the mining space, in my opinion. Definitely checks that box, where now a lot of people are very concerned about what happened with the industry versus what it could happen in the future. And it is just natural that if gold prices do get into a bull market and we do see a major breakout, it would be natural to see that those businesses would actually appreciate significantly, not only in valuations, but also their businesses would actually start making more money. Now, I get it that the cost, it will play a role there as well. And it has been playing a role into the mining space. But I will just emphasize one thing. Cost also impacts copper producers and base metal producers. And if you look at copper stocks relative to copper and gold stocks relative to gold, you're going to see a divergence between the two. And so the cost is not really explaining that. I think, and as his conversations internally, give credit to Quinton on this one, because I was kind of perplexed looking at all that data and asking the question. What he thinks it is, and maybe he can discuss this as well, is the fact that maybe the gold market, if you look at the gold companies, what they hold in reserves, their reserves are basically deteriorating in quality much faster than the copper reserves. And maybe that has to do with that pricing differential between relative performance of gold miners versus copper miners. And keep in mind that gold has also been doing better than copper as well, which, fundamentally you would expect then gold miners to do better, right, than copper. But that's not really what's been happening. And the ESG and all the green revolution and all sorts of reshoring and other things are certainly driving more capital to the base metal space as well. But anyways, I just think that buying low and selling high seems to be a much more of a complex than the simplicity of the phrase. And that to me is why investing is mentally difficult and such a psychological ability to have and being able to discern great opportunities when they are really cheap on the back of a very strong potential for a good macro environment for that particular asset. In this case, gold. I mean, I think the central thesis of why we own the miners is because of our view on gold, and that debasement of currencies ultimately drives, in our opinion, gold much higher 10 years from now. And then what is really mispriced is really the businesses that hold gold and produce gold itself. And even more of that would be the explorers. But that's just our opinion, how we've been allocating capital, but also constructing the portfolio. Let's go to the next chart. And so silver did something very interesting recently. Silver broke out from a quarterly candle formation, as you can see here. So we look at quarterly candles, and silver just broke out. I've been looking at this chart for the last, call it 5 years. I thought that this would happen way before. And I caught a lot of that big move that we had in 2020. And then we've been in this consolidation period since then, which allowed us to really work on our own investments. But, I don't think the thesis has changed. In fact, I think the thesis has only gotten stronger. And seeing this validation on the chart of technical basis, the breakout, I think that we are probably going to retest the prior highs of the 50s and potentially go much higher than that. And so when I think about mining companies and how to even structure a deal in this space, I'm always with my mind of how would that deal look like with double prices of silver, because I do think that that's likely the outcome of all this as we see gold prices continue to rise. And in fact, I tweeted this chart, and my biggest point was that when you have a gold to silver ratio at 90, about 90, one of the highest levels in history, is precisely the time when you want to be focusing on this. In fact, if you go to the next chart, what you're going to find is that the production for silver, if you combine Mexico and Peru, and then we're looking at 12-month moving average for production in those two countries, we're in one of the lowest levels in 14 years. It's a 25% decline in this. And so even from a supply standpoint, I would argue that silver looks incredibly undervalued and offers one of the most compelling opportunities on the macro side that I probably have seen in my career. Let's go to the next chart. And so you can see the roadmap, maybe just like gold in Japanese yen terms, basically was leading the way to the upside for gold in USD terms. Maybe this is the same thing going on with silver. In fact, if you look at silver prices in yen terms, we're actually, there's a major spread that suggests that maybe we should start seeing the blue line beginning to follow the white line. And so to me, this is a very important chart. I think Japan, given the overwhelming amount of leverage in their system and their unwillingness to, or I shouldn't say unwillingness, but being unable to very constrained policies, monetary and fiscally speaking, are being forced to essentially debase their currency relative to hard assets. And silver has certainly been one of them. And as you can see here in this chart, we're 13 percentage points away from all-time highs in the metal in yen terms. And so I think the biggest thing here is that this is likely a roadmap for the blue line, likely a roadmap for silver in US dollar terms. And so I pay close attention to this chart because I think this is a good way to kind of fit your mind into what to expect with silver prices here in the following years. Even let's go to the next chart, and then global central bank assets. So forget about monetary base itself. Just look at quantitative tightening and monetary base. I should say central bank assets overall. They have been declining. And there's a very strong correlation between that, which is in red line, versus the S&P 500 as well. So now what gives is the question I often ask myself. There is a case that maybe the total, what we call the banana republic environment, creates, causes the S&P to just keep moving higher, and the debasement of currencies gets to a degree that we've seen maybe in countries like Germany back in the 1920s and so, and maybe Argentina recently, where the local markets went crazy because of the inflationary problem. I happen to believe we're going to see more of a reckoning just because of a few things that I will present here in a minute. So let's go to the next chart. The main reason for that, I guess this chart got a little lost in the order, but the point of this chart, before I go back to that point, not to get lost on the narrative here, is that we often get really focus on, well, what should I do? Is that copper, gold, silver? The truth is, when you get to a bull market in gold, you get to a bull market of most metals. And yeah, there might be some differences and better opportunities here and there, of course, because silver prices are much lower, have a much higher volatility, offer a better return probability as well, higher risk. Copper does the same thing. It's very cyclical. If you have a recession, it could decline on the back of lower demand, and it's more industrial, just like silver. But if you just step out, forget about all those things I just said, in general, the three prices kind of follow each other. And so, if you believe that gold prices, which is my belief, and I think the firm's belief, that gold is on its way to making, significantly higher levels, you would expect that the blue and the white line in this case would also do the same. Now, let's go back to the equity markets. I think next chart would be on that. So why do I think that's, when you look at the central bank assets decline versus the S&P, potentially could be a little tricky? And mainly, I think, I think our business of money management really falls into positioning, liquidity. Understanding liquidity and positioning are two very important drivers of performance of assets overall over time. And one of the things that I pay close attention to is when you have foreign investors deploying a lot of capital into one place, sort of systematically. And this is precisely what we're seeing today. And foreign investors, if you look at how much they have of allocation in U.S. equities now, it's almost as much, or actually it was more recently in 2022 or 2021. It was more than what we saw during the peak of the tech bubble. So you have to ask yourself, where does the money come from to get another lag of that S&P 500 moving higher? And, this is where I think it gets really tricky, because, when I looked at the emerging markets, and I've had many charts showing the differential of valuations of a business being run in South America, for instance, versus a business being run in the US. Yes, there should be a difference of valuations, but that differential has never been so extreme. I would argue that extremity is unsustainable, and I would argue that we're going to see the convergence of those valuations at least to a more normal level. And as we see foreign allocators, instead of, since they're already fully essentially allocated into US, potentially starting to move their money away from US equities and into other things that are really cheap. I think value investing and fundamentals do matter over time. And I think we're getting to a very close to an inflection point where we can see that shift of holdings from foreign investors. Let's go to the next chart. And so it brings me to the attention of potential risk in the equity markets. And, immediate reaction to that is, hold on, but we're in an election year, and election years tend to be very positive. And yes, I mean, in this chart, I think it represents very well. The black line shows how the average appreciation of the equity markets has been throughout the years during election years. This is, I don't know if there is a year there that shows how long it's going back, 1965 all the way to 2021. But you can see here that the green line is looking at the bull markets and the red line is looking at the bear markets. And you can see there's certainly bear markets, and the bear markets are more extreme than the bull markets. Keep that in mind. And the second thing is, there are a few markets that were really, I would say, causes data to be this way. And one of them was 2008. And the other one was early 2000s. The main point was there were other things happening in the economy that became much greater when it comes to the prioritization of valuing assets at that time than actual elections. And so elections became completely overlooked relative to those other things. In this case, 2008 was the banking system, and early 2000s was a decline of very crowded technology investments across most participants in the markets. And so maybe there's some similarities here. So I wouldn't, just basically say that just because it's an election year, we couldn't see more turmoil in markets. Actually, I've subscribed to that view much more than I would say the average investor. Let's go to the next chart. In fact, it's interesting how the mega cap companies have been leading the way to the upside, and we've all seen all these sorts of charts. Even I am. I've put a lot of charts out there as well, showing how this divergence of the market, in which we've seen kind of the broadening of the market recently as well, by the way. But pay attention to how the 3 out of the 7 mega cap stocks are now outperforming the S&P 500. So the others have all underperformed since December 1st of prior year. And so this is an important chart because certainly the leadership is shifting. And keep in mind what happened in early 2000s, such an important point. Early 2000s, we had a big run up in equity markets and caused by the technology and space, and also caused by mega cap companies too. And then the leadership shifted. We actually saw the broadening of the market at that time, meaning other industries led the S&P to retest its highs, and then we saw that double top, in which today we already surpassed those levels anyways. But ultimately, that broadening of equity markets actually wasn't necessarily a bullish thing. So we often talk about, the broadening of the market with other industries and sectors kind of leading the way to the upside is a very positive thing. But don't forget, the early 2000s, that did not play out as an optimistic thing at all. It was actually the beginning of a bust of a bubble. So I'm much more, I guess, skeptic than the average investor when it comes to technology. But let's go to the next chart. And so, this is a good chart that kind of shows this flows of capital going into technology versus other sectors. This, to me, is completely unsustainable. I don't think we can see this for too long. I think ultimately, and for us mining investors in the mining industry, this is what we need to see is the money coming out of that yellow line, coming into those industries that have been ignored for so long and unloved for so long. And that's certainly in this case here in this chart showing energy on the other side. And but if I put the mining industry specifically, not sectors, but industry base, you're going to see that the outflows have been even more significant in the energy space. And to me is just completely unsustainable. Let's go to the next chart. And so lastly, valuations. You can see valuations from many different aspects. You can see in this one, price to earnings, specifically the most simple way to do calculation of how things are overvalued. And you can see even in that metric, I usually like average, like the cyclically adjusted PE ratio to me is much more appealing as a way to analyze the markets because it kind of reduces that cyclicality in the markets, especially from an earnings standpoint. But even using this one, you can see that valuations look really extreme today. This is thanks to Bank of America research. If you go to the next chart, however, I think this is my last one, also from Bank of America. You can see here in an even more interesting way is separating in 4 different columns, basically price to book, price to operating cash flow, forward PE ratio, and also enterprise value to sales. And you can see in this chart how if we just look at where we are today versus where the median or the average was historically of this sectors, you can see clearly that energy would have to rise 67% in order to get to its average price in the price to book value, for instance, and the price to operating cash flow is even larger. As you can see, it's close to 82%. And a lot of things come to my attention in looking at this. Number one, there are a lot of cheap sectors in the economy today. It's not like, the overall market looks crazy expensive. But the thing that it makes it look very expensive is the fact there's a lot of concentration in technology and consumer discretionary. And therefore, because of the weight of those companies being so high in those indices and the overall economy as well, therefore it causes the overall market to look very overvalued. So what I would avoid here, certainly consumer discretionary is one of them. It looks really expensive, as you can see here, but technology is the obvious one as well that looks very expensive. I would argue that if you look at price to book, a free cash flow basis on utilities, not operating cash flow, because they have a lot of CapEx. you're going to find that utilities actually look very expensive in that metric as well, particularly if we do have a higher interest rate environment, which is my opinion. I would say the capital intensive industries that require these levels of capex, but that have also been expensive already in prices, which is not the case with the mining industry, would probably suffer in this environment as well. So, I think there's ways to analyze markets, but certainly it's very easy to see how energy looks really undervalued and technology looks very expensive. That's one important conclusion of this. I think this is my last chart. Let's just see if it is. And if that's the case, I probably will be ending my presentation. I appreciate the time. I think Kevin and Quinton will be doing their own presentations as well. But thanks for your time for watching this, and I'll be back next week. Thank you.
Hello, everyone. Look, we're doing a recorded presentation this week. So I made this on Thursday evening. If there's any news releases that come out Friday morning, I'll have to talk about them next week. I'm simply tied up in a meeting this week, and I had to make a recording. Try to do the best I can. Hopefully, we can dovetail this with what Kevin and Tavi have already presented. But what I'm going to talk about today is, clearly the gold price movement over the past few weeks, really since the first of the month. I think it was right, that Friday, right before PDAC, where gold started to move. It's amazing how, things can happen right around PDAC. Usually it's bad stuff, okay? Usually 9 times out of 10, it's pretty bad, pretty grim at PDAC. But this year, it was actually upbeat. It was nice to see some smiles on faces. I think, if anything, people are just, elated to see the gold price move in a resounding way. It's well up above 2,100 now. But, is that really good move to see it move so fast? Yeah, you know what? I always like to see a little bit of a rest, in things like that. Volatility is not our friend. I think it will keep moving up. Don't get me wrong, but it's usually best to see things steadily increase. And I'm going to talk a little bit about that at the beginning here. So let's go to the next slide. Okay, I've showed this slide a zillion times now. It is the gold price over about a 23-year period. It goes way back to 2001. Okay, so we're looking at a chart of gold on a monthly basis, monthly candles, clear back to 2001. Seems like the dark ages to many of us. But this has been a pretty exciting period in gold. Okay, this has been a period where we've seen overall a great appreciation of gold price, all the way from $252, I think, in January of 2001, all the way up to the lofty price of 2,160. Almost, not quite tenfold. It's a little over eightfold, I guess. But man, that's pretty remarkable trend. Now, the green bars I've drawn here are basically bull phases as defined by the MACD. So the MACD is down there at the bottom. It's a histogram on a monthly basis, again, of the MACD. And you can see there's these periods where there is a clear resounding strength in the gold price and its momentum. And then there's these periods in between where gold pulls back. It takes a breath. It's not to say that we haven't, we aren't in an overall bull here. I think this chart actually clearly demonstrates really since 2001, we've been in a bull. It feels pretty bleak at times. Like there's the period back in 2012, 13, 14, 15. That was a bleak period. Even recently here, a couple of years ago, as they were tightening, as the Fed was tightening stuff, gold and many commodities were just hammered. So I'd like to put a little bit of, perspective around this and keep emphasizing this. Keep an eye on that big picture here, because this is what's important if you're an investor in this space, or if you're an investor in mining companies in general. Now, in the bottom there, I've got 2 pink circles. One is the period from say 2001 through 2004 or 5, thereabouts, in that broad green bar. The other one is over here in the current time period. So starting about March, I think, of 2023. All right. Now, what I've done in the next slide, please go forward. I show a close-up of that same chart for these two periods. So in the upper left there, you can see a chart starting around January 2001, extending into maybe late 2004. So more or less a three and a half year period, say. On a monthly basis, you can see the gold price moved up fairly steadily, but there were pullbacks. Okay, it would move up, take a breather. Again, the rest stop. Okay, every time it goes up heavily like that, you need a rest. Okay, you want to build momentum. You don't just want to go on hockey stick. You want to build momentum. That's the best outcome for all of us in this space, and I think we're seeing it in the modern day. Okay, so in the chart down here, in the lower right hand side, you can see just so far about a year and a bit of candles there. I think we have a lot of room to run. Hopefully it's as long as the one in the upper left, maybe 3.5 years. But again, we're seeing a fairly steady MACD. It's not just spiking like that. It did this week. I mean, in the past 2 weeks, it's really jumped up. It's gone from, say a little over $2,000 all the way up to 2170 or so. But again, it's going to take a little pause, and everybody can't freak out. Okay, everybody's going to promise me they're not going to freak out if gold pulls back a little bit and does more like you see in the upper left here. Okay, it's got to do that. That's how it builds more and more support going forward. That's just the nature of anything, really. Any trading pattern that you see, if you build support steadily, it's a way better outcome, way better foundation. All right, so I think we're in a bull phase. I think it's got some runway ahead of it, and hopefully it builds nice and steadily from here. Let's go to the next slide. Now, I have been looking at, or talking about, I should say, in videos about, the M&A scene and junior miners and their place in exploration and things like this. Very broad topics around junior mining and exploration. And what I thought I would do this week is give you a little reflection around, my view of junior mining investing. And look, I'm not going to go into details. This is a high level. These are the basics, a 101 level introduction as to how I see junior mining investing. And in particular, I'm going to talk about how we view things here at Crescat, how we approach things. All right, so let's go to the next slide. All right, a lot of, if you were to ask many people who invest in this space, why do you invest in junior mining companies? The explorers, we'll call them. So, some people don't like the term junior miners. They think, oh, that sounds kind of cheesy. Well, call them explorers if you want to sound more sophisticated. But they are what they are. They're small market cap companies that, are out exploring for gold, exploring for silver, exploring for other metals. And, they generally don't have cash flow. They generally do not have cash. That means they have to come to market. Obviously, that, that's a stark difference to, say, a cash flowing company on the, in the S&P 500 or something. These are the tiny companies that are trying to literally at the top there unlock value through discovery. Okay, and that's what it's all about. Junior mining companies, many people who invest in them do so because there's a lot of value, a lot of money can be made by investing in junior companies that make discoveries. Okay, that's the key word, discovery. That's what unlocks value. All right, now, a lot of folks will also argue that, this gives you good leverage to a bull commodity cycle. And there's truth to that. Okay, when the tide starts rising, when the commodity prices start rising, and you see, that tide lifting the boats, all the boats tend to float, all the little boats. Okay, so there is logic here. That is a justified reason to invest in junior mining companies, especially when they're highly depressed, like right now. You can jump into these stories and hopefully as the tide rises, like I talked about a few minutes ago in the gold cycle, we see that tide lift all these and you can make some money on these companies. You beat up unloved junior mining companies. All right. Now, there's a lot of you out there who basically have very, stern view about owning things tangible. And I would agree. I would be in that camp. I'm old school. Okay. A lot of people say gold has no place. It's a barbaric relic and things like this. I would argue quite contrary. I would say that gold and its properties, its natural properties give it the perfect properties to be utilized as a tool, and that's a store of wealth, a store of it should be money. Quite frankly, it was for many, many years. It still should be. Now, is it any longer? No, but it's still a store of wealth. We know that. Okay, it's tangible. It's tangible wealth that central banks like to buy. They like to stick away and have that on hand as a backup to maybe their currencies. Okay, so owning tangible materials, especially with a high value like gold. And look, I'm not trying to be specific to gold here, but obviously most of our companies are gold. That's important to many people. All right. Now, a lot of people see investing in precious metal companies in particular as a hedge against fiat currencies. Currency debasement is ongoing. It's continuing. If anything, it's accelerating. And investing in this space, again, when it's unloved like this, could be very lucrative potentially. There's no guarantees in life, but it could be very lucrative as we see currencies continue to debase. We're seeing gold at all-time highs in many currencies. And now we're seeing it in the U.S. dollar too. The U.S. dollar's finally gotten caught up with a lot of the other currencies, which gold's already rung the bell, so to speak. Okay, so the Japanese yen and even the euro and stuff like that, we're there. The dollar's there. Okay, now some people invest in this space because they really do enjoy, the pure, exhilaration of this treasure hunt. Okay, because that's what it is. Exploration is a treasure hunt. You're trying to unlock value, like the top bullet says. But there's a lot of people that just get their thrill out of that. And I would say some of the best investors that we have seen in this space are those that really love that aspect of it. I put Eric Sprott in that category. I mean, he's very savvy in the financial side of things, but he also loves the treasure hunt. And many, many investors in this space have that same kind of passion. Okay, now this investing is also a hedge against other forms of investment. I won't go into the weeds. That's given to Tavi's jurisdiction, but I would say that people have their own flavors they like, and the contrarians typically like mining related investment. So if you want to be the contrarian investor, say the anti-tech company or the anti whatever corporate bond or something, this is usually where people end up. Okay, but these are all logical reasons to invest in this space. Okay, now go to the next slide. Now, where do we make money in this? Well, we make money usually in two different phases. Now, this chart shows over time, which is the horizontal axis, the value of a stock. Now, it's really an artificial scale. Okay, there's no logic to the numbers that are on that axis, but you can see that during the discovery phase, basically when a junior company is valued very, very lowly, starts to drill. They go out, they do the science that they need to, and then they develop drill targets. They start to drill. And if they make discovery, they can appreciate greatly. You can see the value of that company increase in multiples. All right. So that's certainly one, that pink bracket shows you that one opportunity for an investor to make money. Now, often once a discovery is made, and then it has to go through the more hard yards, we'll call it, the speculators leave, and the stock price languishes. They have to go through engineering and environmental permitting and social license aspects and stuff like this. And it can take time. Okay. And all of that and money. And it really, it's not the place for speculators. That's when they've left the party and they leave their shares to others to hold. Okay. Now that's fine because it provides a second opportunity for investors. And that is once a project advances and goes through its feasibility study, goes through financing, gets into development, and then production. So you can see an uplift as a company comes out of that valley of death, so to speak, and increases value as the company starts cash flowing and generating money for its investors. And look, that is the other way to make money. Now, we focus mainly on the left side, okay, mostly exploration stage, but it's not to say you can't make good money on that right-hand uptick as well. Okay, other people like Pierre Lassonde, the guy who came up with this chart, that's his favorite place to play. I like to play in the exploration space, partly because it's relatively cheap to enter junior companies that are valued at very small values. We'll talk more about that in a minute. Go to the next slide. Now, we've showed this slide before. This shows the takeout price of a suite of companies that were bought over time. They made discoveries, they advanced them, they drilled, they came up with resources, and then they were bought out. Now, back when I created this, I think it was May or June of 2023, the directive that was given to me, and it was actually Tavi, I believe, who provided this, you know, input guidance for me to pick the companies in this list. He said, look, we should have a few, 4 or 5 that are that were bought out in the bear market period of gold, like when gold or other metals were on their back, let's have a suite of those. And then let's have some companies that were taken out in kind of so-so times, maybe when everything was trading in the channel. And then we also have, so neutral, we'll call it. Then we have the green bars, which are companies that were bought in a bull cycle. Okay. You can see obviously the green companies are the companies that were bought in a bull phase often go for a very high valuation. We're not in that yet. I mean, we're in a bull in the gold space, but not necessarily in the mining space yet. Will that come? I think, yes, over the next 2 or 3 years, we will hopefully see that bull cycle come, which means the value for a lot of these companies that do have discoveries could see those kind of premiums come their way. But in the meantime, you have to kind of look at this realistically. So we got a kind of a spectrum here of different takeovers that were done in bear, neutral, and bull markets, but it gives you a sense. It's not perfect. It's, you could probably do another 20 companies here and analyze them all, but at least gives you a sense of the kind of value you can create. And look, the average here is 22%. I think if you take out the Frontier Gold acquisition, I think if you just take that one out, it drops to something like 20%. But that's, what is that? That's some value of the metal in the ground. Okay. So basically, if a company found 10 million ounces of gold, on average, taking Frontier away, we'll say, that's about $2 million of gold value in the ground. So if gold's trading at $2,000 an ounce, it's $4 billion. Right. So in theory, discovery should trade for that. Now, obviously in a bear market, they ain't going to trade there. Okay. They might trade for 8 or 10% or something like that. Who knows? Somewhere in that range. If it's a neutral market, maybe it's 10 to 20%. I don't know. If it's in the bull phase, yeah, they're going to trade generally at a pretty healthy premium. Okay, let's hope that bull phase comes back, because that's when you do make a lot of money. Now, this actually relates to the previous chart I showed you. If you think about the Lassonde curve, and you think about, it shows you a pattern for junior miners. But if you think about it in terms of the cyclicity of the gold market, that chart may be up here or maybe down here. In other words, right now, the Lassonde curve might be like that. Whereas if it's a bull market, it might be like this. You got to bear that in mind too. I would say that right now we're at a period where the liquidity has been very low in the mining space for a long time. And because of that, and because of the lack of interest in this space, we are seeing an abnormally low, bearish phase in the mining cyclicity. So the Lassonde curve, while it does play out, like companies that make discovery, they are rewarded value-wise. They're not going nuts like they did, say, back in 1980 when Hennigh was found or something like this. Like those were like, they truly rang the bell. But it is what it is. We gotta assume that there is value though to be unlocked even in a bear market. All right, let's go to the next slide. Now, I summarize what we're looking for. This doesn't include everything, but a lot of things. Okay, it's what does Crescat look for in an explorer? Okay, first of all, I like to see a company that has a commanding land position over geology. So it's got to have a geologic thesis that can deliver a world-class mineral discovery. Okay, I don't want to see, scrappy little pieces of land and, scattered all over the place. I want to see a nice cohesive land package that gives us an opportunity to fully test a hypothesis, an exploration target, like it should be. All right. I don't want to have to chip away at it and do complex deals or something or whatever, or find out we found half an ore body, God forbid. These are not what we're interested in. Okay. Now the second part, it's got to be in a jurisdiction that has a recent history in which mines have gotten built. Okay. That's it, pure and simple. If I don't see evidence that mines have been built in a jurisdiction, say within the past 5 or 10 years, I'm not interested in investing in that. Okay. So every place that we've invested, you will see mines somewhere nearby that have been put into production within the past few years. Okay, now the other thing we look for, third on that list, solid technical and management team, but also the willingness to bring on expertise should they need to fill weaknesses within the company. Okay, now there's a lot of small teams out there, good people, but they might need help. Okay, and I'll talk more about that in a minute because we get activists. Okay, I'll bring that up in a second. All right, let's go to the next, or sorry, not to the next slide. Sorry, the next bullet, and talk about the willingness to develop drill targets using sound scientific approach. Okay, and the follow through. Okay, it's not just an exercise in science where you're going to go out and come up with a hypothesis. We want to test the darn thing too. Okay, so I like to see companies that go through a methodical process of collecting data, developing their drill targets, which one could refer to as their hypothesis, think of it that way. And then they go out and they test their hypothesis, i.e. they drill. Okay, this is very important. There's a lot of companies that, for whatever reason, they chicken out. They lose their nerve. They're afraid to drill because they might drill and kill something. That's not what I want. If I don't see people swinging for the fence, I'm not interested. It's a waste of time. Okay, the other things I like to see, pre-discovery level valuations. Okay, usually we're talking about maybe a few $1,000,000. Okay, because that's, again, nice and cheap. It's a sweet spot. A little fund like Crescat can actually get a meaningful stake in these companies because they are truly cheap. All right. Now, I also like to see an ability to tell the story. Companies that have, ability to market and get out and tell their story, those are great too. All right. Now, we use our activist approach in several places here. Okay. I've put a little asterisk next to 3 of these. If companies don't have the technical team they need, I will go out of my way to ask around and see if there's people that could come in and help, either consultants that could come in and help, or even employees. I found geologists and stuff to work for various companies at times, or engineers, or whatever. I like to do that. I know a lot of people in the industry, and I think that that's a very constructive way to work with companies that we invest in. All right. Also, willingness to develop drill targets. Like, there's a lot of people that just like to go willy-nilly. I got to tell you, there's folks that like to just say, "Oh, we're going to drill this summer." Okay, well, what are you going to drill? I don't know. We're going to drill this summer. I don't like that. Yeah, that's not what I'm interested in. I like to see folks that do that science, and I like to help them with it too. Okay, I'm an exploration geologist myself, and I will stick my nose in. Usually when we take an investment in a company, we have a statement that says what the proceeds will be used for. And it's usually specifically to go to, some aspect of advancing a project that's going to maximize the success, hopefully make that discovery. Okay. So we do like to take on a bit of a hands-on approach with some of these explorers and make sure that, they're heading in the right direction and they stick to the script too. Okay, now telling the story. Well, that's why we do the videos. Okay, this is my opportunity to give you updates on companies, their progress, their news that's come out, and things like that. So we are activists. That's where we're activists, and this is how we approach exploring or investing in exploration companies. Go to the next slide. Okay, now the universe of juniors out there is big. Okay, there's something like 2,500, I believe. I think if memory serves, In Canada alone, there's like 14 or 1500 junior miners. There's like 8 or 900 in Australia. There's a few on the AIM exchange, a few in the US, even South Africa and stuff like that. So there's a pretty broad base of junior miners listed around the world. Okay, but the bad news is this: only a few of those, okay, maybe a subset of 15, 20% meet the criteria that I had on the previous slide. They've got all of those aspects, okay, but even there, we have to winnow it down further. I do meetings, Zoom meetings and whatnot with these companies, or I might even go to the property or whatever. Like I do a lot of work to research the company, its project, and the likely outcome in terms of discovery. And as we whittle this down, we get down to a small spot there, that red spot, which is maybe 70 to 90 companies is the subset that we're going to pick out of that entire universe. Okay, so if you think about it, that's less than what 3 or 4% or something. It's like, what is that? We'll call it 1/30th, so about 3%, 3.x% of the entire universe of juniors. We're fairly picky in that regard. Okay, but those are the ones we put our money on. And it's based on those criteria that I showed earlier. All right, go to the next slide. Now, in our portfolio, we have companies that, we have 80, 90 companies, call it, that are all heading in different directions, different speeds and stuff like this. There's no uniformity whatsoever amongst the herd of companies that we have. Some are even pre-IPO, and I talked about that a few weeks ago about some of our private investments. Okay, but all of these companies are basically, we'll say not all, but most of them, 95% are squished down on that left-hand side of the Lassonde curve, and they're, some of them have broken out. We'll talk about that in a second, but most of them are over on the left-hand side. Okay, they're all kind of clustered in that tight little space there, relatively low value, but have good potential. All right, now once the companies get to work, many of them end up on the right trajectory. They're doing the right things. They're gathering data. What I like to look at is the data that's coming in telling us, giving us better and better indication that there's something here. In other words, are they on the right trajectory? That's the stuff I like to monitor. Okay, and that's why I give these little podcast things to help you guys understand, if a company's on the right trajectory or not. Sometimes they aren't. Okay, but there's a subset of our portfolio, we'll call it, that's on the right trajectory. Now, there's some outside of that don't succeed. That's the fact of life. Okay, I'll talk about that more in a minute. All right, now, as companies do work and they get more data, they start drilling, and they can start to see sniffs in their drilling that say, hey, this is an incipient discovery. I call it incipient. People don't like the term. Some of them, I like to use it because I think it's a reasonable term. If you start to see indications in the drill hole that, hey, we're pretty close to an ore body or something like that, I call it an incipient discovery. And there's quite a few in our portfolio, thankfully, that have made that are onto something, incipient discovery. Sitka, I'll show you here in a minute in the updates. They look like they're onto something. All right. But then there's also the discovery level companies. That's the pink dot in the middle. Those are the ones that have made a discovery. It's clearly going to, even if it hasn't got a published resource, clearly going to deliver a large resource of some sort. And we have a number of those. We're very fortunate over the past 4 years to have a considerable number of discoveries in our portfolio. And those are the ones that go up the Lassonde curve and return the most value. All right. So that's what it's about. That little pink dot, the winners in that can actually make up and even add value to the entire portfolio, because when you make a discovery, it unlocks a lot of value. And those are the ones that everybody dreams of. They're the ones that we all, are rooting for. We're hoping we'll make that discovery. It ain't all of them, but it's, we've been fortunate. We've been very blessed. Thank you. Let's go to the next slide. Now, I have put this slide in here to give you a little bit better perspective how I see our portfolio at any given time. Okay, there's companies that I'll say are working at it, kind of like the guy in the upper left there who's panning for gold. He's digging up a little dirt, panning it out, putting more dirt and panning it. He's looking for that price, so he's working at it. Okay, many of our companies are working at it. Have they made that discovery yet? No, but they're clearly seeing indications. They're seeing some sign that they should keep going. Now, unfortunately, there are companies that go into the weeds. Sometimes it's self-inflicted. Okay, you might have companies where the management, for whatever reason, decides to go off on a wild hair. They either pivot to something else, they spend their money elsewhere instead of sticking to that script that I talked about. And unfortunately, we've had a few cases where our investments, even ones I've talked about here, went off the rails, and they lost sight, they lost their vision. Okay, and it happens. It's very sad to see it. It's very discouraging. But there are companies that happens. The other way a company or a project can go into the weeds is not necessarily self-inflicted. It's from outside factors. Okay, so for example, a jurisdiction might go pear-shaped. Like I would say that Mexico for us has been downgraded significantly because when you have a president that talks about banning open pit mining, it's not really a fun place to invest in mining. Okay, so that's another way one of these junior companies can go off in the weeds, is if factors outside of the company kind of lead it in that direction. Okay, now one of the biggest problems we have right now, because liquidity has been so tight and there's been very little money coming into the space, is that these companies are struggling with cash. And this is a big factor, guys. These are risks. The risks that I'm talking about, the reality. All right. Running out of cash is a big one right now. A lot of people, hoot and holler, and they say, "Why aren't you talking about this company or that company?" It's because they haven't had news out for months and months. Okay. They've probably run out of cash, or they've decided to conserve the cash they have, and they're just hunkered down. This is a tough time. And there's a lot of companies in that space. So you got to be aware of that risk. I mean, that's a huge risk. It could be a great story. And I think we have a lot of great stories that simply have, a situation right now, especially because of liquidity and the lack of investment in this space, that don't have the cash to advance their stories. And it is heartbreaking to see that. Now, I'm hoping as the metal prices tick up here and that money hopefully starts coming back in, that tide starts lifting, that these companies will get cash over the next few months, maybe year, and we'll see them get back on their legs. Okay, like literally, like the phoenix come back from the ashes. All right, now this is where we can help. Right now, we're not hugely flush with cash. We try to help mainly our existing stories, help keep them financed and work with, help them. Like, we're trying to be constructive here. But there's only so much we can do. It's been tough. We don't see that abundance of cash coming in that we can deploy routinely. But that will change. That will change, and I guess I would turn it around and say that's the opportunity. Okay, why is everything on its back? That reason right there. Running out of cash has been a big issue. These companies are cheap as chips. And there will be wonderful opportunities for all investors, including us at Crescat, to work with these companies to get them going again, getting them back on their feet, and getting that value out of discovery. All right, and then lastly, down here in the lower right, we have the companies that make that discovery. They find the big one. Look at Snowline. What a dream! An amazing discovery. Okay, it's just hands down one of the best gold discoveries I've ever seen, I've ever been associated with in my career. I love it to death, and it's been a wonderful success. We have other discoveries that like El Oro, huge system. Oh my gosh, unbelievable huge system. Zinc, silver, lead, tin, the works, a smorgasbord of metal. Absolutely huge system. Value's been trimmed a bit lately, I think mainly because people know they need cash. But nonetheless, it's a great discovery. Okay, so there are a lot of discoveries that we have that aren't seeing full value. You remember the Lassonde curve? I think this is what we're seeing in the Lassonde curve right now instead of the big ones. Okay, we will get back to the big Lassonde curve soon as metal prices recover. Okay, go to the next slide. I have just a few updates. Surprisingly, look, there hasn't been a lot of news. I think as people don't have a lot of money, they don't put out a lot of news. But I'm going to give a few updates that have popped up both the week of PDAC and then this week. Go to the next slide. One of them comes from Sitka. Okay, they put out a news release, I think recently, like in the past day or two. Yeah, that's this morning. Sorry. This image simply shows the gold mineralization at the RC project in the Yukon. This is that reduced intrusive hosted gold mineralization. They've got the Blackjack deposit and the Eiger deposit, likely going to connect at some level down there. Okay, these are related to granite magmatism. And if people recall, I came up with a thesis, or I should say I identified a thesis that they were working on, that this hole 47 with the green arrow pointing to it, that was drilled last year, which had higher grades in it, could be telling us there's something better at depth underneath that Blackjack deposit. Okay, so when we put money in, one of the things we specified was we would like to see a deep hole drilled that retests the area at 47. We want to see more of what's going on down there. Okay, let's go to the next slide. This is core from that hole. Now I can't tell if it's 62 point whatever meters, or I don't know what those numbers are at the bottom. I don't have a clue, but I'll tell you what, that rock right there, that's enough to get a geologist like me pretty excited. Why? It's a crowded porphyry. What does that mean? There's these big white crystals in there, okay? And those white crystals are of a mineral called feldspar that in a molten state, like in a magma chamber inside the ground, they tend to be less dense than the stuff around them. Okay, so they like to float as they crystallize and come out. They precipitate into these little polygonal shapes. They like to float up to the top of a magma chamber. And when I see what's called a crowded porphyry like this, where you just have an abundance of these big crystal phenocrysts of feldspar, that tells me you're probably at the roof of the magma chamber, because these things like to float up and kind of collect up in that top part. Why is that important? Well, because these systems, these metal systems, are intrusive hosted. They're associated with these reduced granite intrusions. Wow. Okay, so what are you saying? I'm saying that here it looks like, because this stuff is preserved, they're seeing this down in the ground as they drill down. It looks like there's a magma chamber down there that we're just getting into, like a completely preserved magma chamber. So I get excited by what I see here. I also get excited by the veining they're seeing. That's quite interesting. Looks a little like snowline. Okay, not a lot of sulfide. That's good. That's like snowline. Rhythmic, repetitive veining. That's good. That's like snowline. Porphyritic granite. They even see that over snowline. Tick, 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 tick. It looks good. Okay, we're gonna have to wait though. They got to drill this hole. I don't know how deep they're going to drill. Hopefully, they drill down to the bowels of the earth, and we find out there's a completely preserved valley type discovery to be made right there underneath the Blackjack zone. Okay, but this is exciting to me. I know most people probably look at a box of rocks and go, yeah. But now you know why I get excited. Okay, go to the next slide. Okay, back during PDAC, Goliath put some news out. Again, very technical, but it's very important. Many months ago, when they announced, I think it was back in 2023, after they got all their assays out from 2022, I said, wow, look at all these gold hits, and there's a lot more structure here than just the shear bed zone. And like it was clear there was a lot going on. And then fast forward in 2023, they drill more, they hit many more gold hits. All right, so now they got just a myriad of gold intercepts in the subsurface that need to be kind of connected and reconciled and rationalized. Like, what is going on here? They've done that. Okay, this is an important step for a company when you're drilling and you're hitting stuff like this, and you have to sit there and do that detailed technical work to start connecting the polka dots and making sense of what you're drilling. This is a very important stage for a company, because it's It's part of the process of defining the system, the veins and whatnot, so that you can ultimately produce a resource. Yeah, I'm not going to take you through, a long dissertation about this, other than to say, look at the news release, look at the images like the one that you see on the right there, and you can see there's multiple structures. Okay, it's not just the sherbet, right? We've got multiple structures, all of which are very expansive. They seem to be connected at various levels, kind of like leaves touching one another, all stacked up. This is incredible. This is a big gold system. It's turning into a much bigger gold system than we originally thought. And even sherbet looked like a very big gold system. Okay, so it's very nice to see the company do the hard yards, the hard technical work. It is kind of what Newfound went through, say a year ago when they started building that detailed model of the veining that they were seeing at up in Newfoundland at the Queensway project. All right, let's go to the next slide. Okay, Lab Gold put out some news that almost slipped by me, but they actually had a pretty good drill intercept, 10.60 grams gold over nearly 6 meters at the big vein. You can see over here on the map, of course, this is just north of Newfound Gold. That big pink line that's kind of trending north-northeast there, that's the Appleton Fault Corridor. And guess what? The big vein has delivered some pretty decent assays. They will likely find more high grade there. I mean, this is starting to smell, like a Newfound level discovery here. But the company has spent a lot of money too. Okay, it's been a bit brutal. Classic example. The company's doing the right things, making the right moves, but it's also chewing through money. But it is nice to see them return some results here. I kind of hadn't seen news out of them for a while. It's nice to see them pop their head up. I take the view that there's value to be had here, given the market is turning. Gold space is improving. Lab Gold might be one of these phoenixes that comes back here soon. Let's go to the next slide. Newfound had two news releases over the past couple of weeks. One was just recently here, I think it was a couple of days ago, about gold intercepts at Iceberg. Very stout gold intervals. We're talking 400 or 500 gram meter in a couple of cases. And then they also had their 3D seismic data, their interpretation of the data come back. I'm going to talk about that first. Go to the next slide. Okay, so these are seismic sections. They're basically interpretations. So you have two on the left that, top, bottom that go together, and then two on the right, top, bottom that go together. The bottom images are basically uninterpreted data. So basically the raw data without any squiggles on it, drawings on it. And then up in the top there, you can see the veins, the actual veins that they've drilled, and then interpreted veins, dash yellow and so forth. Okay, I put a green line on there too. Okay, why did I put the green line on? Because I wanted everyone to have a sense of how deep that they've drilled so far. Okay, the green line is basically the depth to which the company has drilled in the area around Keats and then over here at Lotto and Monte Carlo. They haven't tested below that, but look at all the structure down there. Oh my gosh, there's just structures going way down to the bowels of the earth. It makes sense. Okay, these systems are deep rooted. The fluids that come from 20 kilometers below the surface, so even well below these seismic sections. But what does this tell us? It tells us that there's a myriad more structures to be tested here. Some of them, like say the Cook Zone or whatever that's called over there on the Cook Zone, I think, over there in the upper left, just tested with a couple of holes. But look at that. There's clearly a structure. There's even a structure below it. There's a lot more to test here, guys. There's a lot more gold to be found. This is wonderful data. I think it's even better than the data I remember seeing from Fosterville back in the day. This is going to be a big gold system, guys. I have absolutely no doubt that the plumbing and the complexities and structures down here, all of these things are ultimately going to deliver, bodies of mineralization that will, in aggregate, amount to one of the biggest gold camps in Canadian history. Okay, but you can see it is a complex story. It's going to take a lot more work. But what does that tell us? It means there's a lot more upside. Okay. All right. So let's go to the next slide and talk about results from Iceberg. Now, there were some results come back. The ones in the little red boxes are new results. They did, twist and turn the drill around here and there, and they're starting to see more intercepts pop up from different orientated veins and whatnot around iceberg. First iceberg east looked like a nice continuous corridor, in large part it is. But as they drill more, and this is very typical of these high grade systems, think about those previous images we saw and look at all the little yellow lines. The more and more they drill, the more and more breaks they see in the ground where fluids kind of came up and did their business and deposited gold. Okay, so this is really exciting. There's a lot more structures that they're uncovering every time they drill. I've talked about this multiple times, where it's a story that keeps on giving and giving and giving. It's one of the most remarkable gold systems I've ever seen in my life. Okay, go to the next slide. Company I haven't spoken about for ages, popped up on the radar here recently, and I got to do a little bit of digging on what they're up to. Okay, some companies come back, like the Phoenix, they come back out of the ashes. Harvest Gold had a project in British Columbia like 2 or 3 years ago, and we invested in them based on that. They tested it, they didn't hit. Okay, they were one of the companies that didn't quite hit, but they had the passion and commitment to try to remake themselves. We have largely stuck with them, and are really glad now to see them pop up again. Now, what have they done? They've identified an area in Quebec. This is next to or near a very prolific and exciting story that's developed over the past few years around Windfall and the Berry areas off on the right hand side of the map image. Okay, the pink is granite, the green is greenstone. We want to be in the greenstone. What have these guys done? They've picked up a strategic land position in what are really the continuations of those greenstone belts further to the west. Okay, yeah, there's a break where the pink is. Greenstone does that. The granite's kind of intrude and they cut it out for a bit, but then they pop up again, kind of like a sea serpent, sticking its, like Loch Ness monster or something. Anyway, over here on the left-hand side of the map, you can see they picked up some pretty expansive property positions. This is big company kind of stuff. And there are gold occurrences on these. There's also good geophysical evidence. If you look at the mag, that tells the story. If you can see linear trends going through the property, you're on a greenstone belt. And each one of those big blocks they picked up has lots of expansive greenstone to explore. This reminds me of some of the stuff I've seen in Australia over the past few decades, where a little pip of a company picks up land and then goes out there and just makes a world-class discovery. Now, I'm not saying that's going to happen here. I don't know. But what I say is, if you're a company, you're picking up a commanding land position like this. In fact, they got 3 commanding land positions over this greenstone belt. Wow. Okay, that's where I like to play. This is my kind of sandbox. Okay, I'm going to do a little more digging into this story and try to learn more. Let's go to the next slide. Okay, Line 1 gave 2 news releases about a week ago. One was an update on operations, and the other one was talking about a discovery they made, a mineral discovery that they made to the northeast of Tuvalu. All right, first of all, mechanized mining. What is all this stuff they're talking about here? Mechanized mining, stopes. Okay, when you develop a mine, you put a decline down, your development. That's how you access, the access stuff. That's how you get down into the ground. And that's where a lot of the ore came from that they used to kind of kickstart the mill a few months ago. It's not necessarily, high grade. Like, that's development ore. It's going to be highly diluted, but they need to get down there to start developing the stopes from which they can extract very selectively the mineralization that is higher grade and the ore bodies effectively. And at Tuvalu, they got a large number of these things. The company does a great job putting maps together showing, the myriad of little veins. Again, it's like the branches of a tree. They're up in the tippy top part of the tree right now. Okay, they're starting to develop these stopes, this production stopes. This is where materials derive that should be higher grade. They've got a lot of work going on right now to ramp this up. Why? Because they want to get more tons out. They want to get more tons delivered to the mill. They've also got their mill. If you notice the middle bullets there, they got their mill commissioning going. It's a process. They started out, I think, with just gravity. Now they've got the gravity concentrator in continuous operation. You also have the intensive leach reactor. That is a big part. That's the cyanide leach component of the mill. That is now in operation. I know that they were waiting on some parts and pieces for that for a long time. They got those in place. All right, so things are coming along. They're coming along. Let's see. First hole long hole drill is in operation. Okay, there are places where they can act, the zones, the mineralized zones are wide enough. They can do long hole mining, which is a much cheaper mining technique. I can talk about that more at another time. I won't bore you right now, but that's really encouraging. That means they can start getting big tons out. I know these guys want to head to 500 tons, maybe even more. Who knows? uh, per day over time. So it's good to see them do this. I know also they're putting the decline down to that 500 zone. That's going to be a big deal too, because as you go down and get to the bottom of the tree, you get the bigger and bigger branches. That 500 zone is one of those big branches, very high grade, and they want to get down there too. So this is good news. This is all good in my view. Let's go to the next slide. Now, the map in the upper left there shows an area where they did some drilling about a kilometer to the northeast of Tivati. They drilled some holes in an area that, for various reasons, was anomalous at surface, but various reasons has turned up long intervals of low-grade copper. Interesting. So you can see the drill traces over here on the right-hand side. Some of those are very long intercepts, porphyry style, we call it, grades over long intercepts. They don't quote the gold grades in there, which is a bit curious, but whatever. They're long intervals with copper. Now, I remember last time I was at site, there are areas to the north of Tuvatu that have copper mineralization. There was some high-grade veins found at surface, but they're now starting to see stockwork veins, like in the photographs down here in the lower left. You can see some stockwork veining, potassic alteration, which is what you want to see in a porphyry. This might be telling them they're getting near a porphyry system as well, porphyry copper gold system. Okay, it's an interesting development. Did they expect it? Was that what they were targeting? I think they were targeting high-grade veins, but the anomalism led to this. Now, this is maybe an incipient discovery. Who knows? Okay, but this is the thing that really intrigues me. Reminds me a lot of the Ridgeway discovery. Ridgeway was a project near Cadia, where high grade was discovered. Very robust high grade copper gold mineralization was found in a very similar setting to this. So let's hope they are making something really exciting here. All right, let's go to the next slide. Okay, and I think the last update I have this week is Fathom Nickel. They put out a news release in the past day or two that talks about drilling that they've done both at Albert Lake, but now at Gawkager Lake. Once again, they're going back to Gawkager Lake, and they're going to test that deep off-hole conductor that they identified from hole 9 last year. And I'm really interested to see where this lands. Everybody's kind of waiting with bated breath, because there was a very strong signal downhole from that, very strong EM signal that might be telling us there's a sulfide body down there. Okay, so the company has basically conserved a lot of its money and drill meters budget from Albert Lake, and it's going to apply them to Gawkager Lake. I think they also plan to do some more geophysics here with this ice over the ground this time of year, and hopefully enhance these targets further. But they are drilling at Gawkager Lake, and I'm very anxious to see what they turn out. All right, so that's it for this week. I appreciate everybody's attention. We'll try to come back next week with more exciting news. Thank you.
If you're interested in learning more about Crescat's investment strategies, we encourage you to reach out to Merrick. His contact information is on the screen now. And, we are here to, learn more about your personal situation and how our strategies might be able to fit with your needs and goals. And, it's important to understand that, nothing that we say in these videos is a recommendation or personalized investment advice. So if that is something that you're looking for, we encourage you to reach out to us. So please do contact Merrick. We look forward to hearing from you.